Brian, did you have that rock'em sock'em thing when you were growing up? Remember you hit the guy and the head would pop off?
I always wanted one, but my parents instead just got me and my brother, Sugar Ray Leonard, boxing gloves. And so we did a real-life version of it instead.
Yeah, I thought about that as Danny was talking about feeling the pinch.
You used to be a boxer, right?
Well, I got hit in the face. So obviously, it's pretty obvious, right? Hit in the head too many times. But there's this feeling of a pinch. We're starting to see that, and we're starting to see that across some consumer spending levels as well.
Yeah, we really are. And we also got some confirmation that people are feeling the pinch. It's not just showing up in the data as far as a slight slowdown in consumer spending. It hasn't been a dramatic slowdown, but we will get more data about that in the next week as far as retail sales for the month of April. But what we're hearing from the companies that we can invest in is that consumers are very sensitive to prices, and that wages, while they've been growing, 3.9% year on year was the most recent data from the federal government. That's barely keeping up with inflation. So consumers are feeling that pinch. It's a small pinch right now, though.
And you think about where that's coming from, of course, and you think about economic stratas, right? And those who are making less money feel that pinch more. Yeah. And those on the top, though, they're spending a lot of the money.
It is, and that's one of the reasons why you can see luxury good retailers do quite well, but yet the more consumer staples, kind of run-of-the-mill retailers not doing quite as well in terms of not only the total revenue, but the volume and what they're also talking about in terms of guidance. When we were looking at the data, the top 20% of American households represent about 40% of consumer spending. And so if you think about that, that means the other 80% really has to pick up the rest of it, the 60%. Now, the top portion of the consumer strata, they also have less debt. They might benefit from these higher interest rates because they don't have a lot of debt, where it's really everybody else who maybe have a little bit more debt, a little bit more interest rate sensitive. And so it is this kind of environment of consumer haves and haves not.
This is also for business as well. You saw that there was a survey that came out, and that was not just for consumers, but for businesses as well. Higher interest rates are affecting them as well.
Yeah, especially when we look at smaller businesses. Small businesses tend to have higher cost debt. They have to rely a little bit more on financing, and they are paying the price with these higher interest rates. When we look at the markets, this could go a long ways to explaining why it is that the mega cap tech stocks, where they have very little debt. In fact, sometimes they have negative net debt, just meaning that they've issued debt, but they have so much cash that it actually ends up being about a negative number. So they actually benefit from higher rates. Why those stocks have done quite well, but it's the smaller cap companies, and especially small cap value. So the value just means that those are companies typically a little bit more industrial-oriented materials, things like that, lower price to earnings ratios. They tend to have more debt and are a lot more interest rate sensitive.
And the reason why we spend so much time talking about the Fed, for example, in interest rates is because it affects Main Street. It affects you and I. It affects those people who go to the grocery store and the gas station. So inflation, up 20 to 25% over the last number of years does affect people. So let's switch gears and talk about the earnings. And we're basically through earnings season, about 92% so far. Yeah. And it's been a mixed bag.
It really has been. It depends on the company, depends on the sector. But overall, with earnings per share growth, it has been above expectations. So around going into earnings season, analysts and the sell side, they were expecting about 3.5% earnings growth. It's come in at something closer to 4, maybe 5%, depending upon if you want to exclude certain items or not. But earnings growth has been positive. But what we're really interested in looking at is what's been happening with earnings expectations, because earnings going through earnings season tell you what has happened. The market is always looking forward. Earnings expectations, interestingly, have begun ticking up. So even though we saw a rather weak first quarter GDP number, we're seeing some signs of consumers experiencing some fatigue, maybe coming under some pressure here. Business analysts are actually expecting earnings to begin to accelerate from this point forward. A lot of that has to deal with the cost cutting that a lot of businesses have already done. I think a lot of people forget that in the S&P 500, they had a profits recession last year, declines in their earnings per share. And now they've really retrenched, refinanced if they needed to, and are really having a lot more operating leverage to hopefully get some earnings per share growth going forward.
And so what is the correlation historically between future earnings growth and actually the performance of the S&P 500?
It's a great question. Over the course of short periods of time, let's say months or even a year, there's very little that you can really hang your head on because a lot of it is driven by price to earnings, the price that people are willing to pay for those earnings. But when we look at over the course of 3 years to 5 years, there's a very strong correlation. There's some people say that earnings are like the seed corn that you need in
I've
order
heard
to
mother's
grow.
milk, right?
Yes,
I
the
like
mother's
seed
milk
corn,
is
right.
another one as well. And it's so true. So over the short term, things are really driven by sentiment and valuations. But when we sort of clear out the noise from that and look at that longer term trend, that positive earnings growth trend is really important to keep your eye on.